A very good morning and good afternoon. Welcome to the Financial Source Daily Sentiment Session with myself, Giles Coughlin. Hope everyone had a good weekend. Hey, Mark. Morning. Good to see you both. Good rugby on the weekend. TM. Good morning. Casper. Hey, Josh. Ollie. Ruby. Incredible to see Scotland playing like that. Amazing. I was really pleased to see them. Hey, Josh. All right, folks. As we get stuck into today's session, there's one thing to repeat three times: energy, energy, energy. It's all about oil at the moment. And before we get looking at the sentiment, we're essentially exactly where we were at the end of last week. It's just things have become a little bit more heightened. So if you look at the bond market, you can see been a further sell-off in bonds, and that's because investors around the world are saying, "Uh-oh, oil prices are so high." And you can see here, where are we? The oil prices spiking over $115 a barrel, right, overnight. Oil prices are so high that that's going to increase costs around the world, which means central banks will have to keep interest rates higher for longer, just as investors were starting to price in interest rate cuts. If we look at the short-term interest rate market tracker, you can see very clearly, look, Federal Reserve is now higher for longer. The ECB, net energy importer, look, higher interest rates for longer. Bank of England, look, higher interest rates for longer. Reserve Bank of Australia, higher interest rates now for longer. Bank of Canada, higher interest rates for longer. Do you see? So investors are saying, uh-oh, interest rates may have to stay up. They may even have to increase now. And that's really weighing on sentiment heavily. Remember, we had the supply shocks of COVID. We've been dealing with inflation soaring around the world, just starting to see it come down. So if you look at the US core inflation, look, coming down towards that 2% target, headline inflation coming down towards the 2% target. And the fear is that it's not going to be able to get there at this current rate. And now we have that game of cat and mouse. How long can Iran hold out? And how long can the US hold out before higher energy prices and repricing of interest rate expectations crunch equity markets and force the US to stop attacking Iran? That's the battle, okay, from a geopolitical perspective. And if we look at this now in terms of the equity markets, gap lower, gap lower, gap lower. Look at the DAX, that was, down 1.5%. Euro stocks down nearly 2% on the day. FTSE down 1.5%. Volatility spiking above 35. It's a clear, right, bearish market that's struggling with an energy price hike due to geopolitical stress. That's the market environment we're in. And that's like the dominant narrative, and it's just eclipsing all other narratives for now. So we only need to focus on that. The equity space, if we just go to what we're seeing, the currency space, we're seeing dollar strength, CAD strength, obviously on the higher oil prices, a bit of New Zealand dollar strength, euro weakness, yen weakness. So the thing to focus on is euro importers, oil and energy importers versus oil and energy exporters. So for me, the standout currency pair to trade is the euro dollar. Eurozone is more likely to be impacted by higher energy prices than the US, so that should create a euro dollar sell pressure. That's just the consistent and constant pressure. And also Japan, a net energy importer, and that creates a pressure on the dollar yen upside. So two trade opportunities: euro dollar shorts, dollar yen upside, and of course oil is an opportunity. So we're going to look at two or three opportunities that I can see in those currencies and the commodity, as well as which headlines to look out for as we head into the session. Now, just in terms of the data we've got coming out this week, we have inflation data coming out this week for the US. That's going to be likely to be a market mover because it could push us in the existing direction depending on the sentiment when we get to Wednesday. So just keep that in your minds. And then non-farm payroll, we saw a weak print come in for the last non-farm payroll print. The market's just looking through that. for now, but we just need to keep it in our mind that the last NFP has been very weak. So that's a sort of narrative that will quickly come back to the market's attention if and when we get through this latest crisis between the US and Iran. Remember, current expectations is that the US hopes to get this done in between 4 and 6 weeks. So that's kind of the framework that we're looking at. One area that the US can impact oil prices is by releasing oil reserves for the US emergency reserves, right? They have reports coming out that the US is pushing for about a 300 to 400 million barrel release, right? So that's about 30% of the IEA's energy stocks. That should make oil prices move lower. And in fact, that's probably why oil prices are dropping at the moment based on that. It will relieve a bit of pressure. The IEA did do this as well with the Russian invasion of Ukraine. So there's precedent for that. That's going to be the US's major focus. How do we stop oil prices surging? And so how do we stop that big sell-off that's happening in the bond market? So just remind yourself, like, this is an energy crisis essentially. That's obviously humanitarian wise, it's a great tragedy. We're just focusing on in this context on the impact it has in the financial markets. And from the financial markets perspective, this is an energy crisis. And that's what we're focusing on. That's where the relief will, the problem has come through the energy markets, but the relief will also come through the energy markets. So let's just take a look at sentiment, right? Although it's quite straightforward, we want to be looking at the major sentiment as we see on the daily European opening news. Just checking anything that we haven't missed. Obviously, oil prices surging, right? Crude futures pulling back. Joint release of emergency oil reserves. Okay, so that's oil reserve. That's helping the oil markets pull back. Let's see what's going on in the FX space. Dixie surge haven bids. So we're expecting more dollar strength. Euro dollar dipping under the 1/600. That's going to be a crucial level. We'll look at that in a minute. Dollar yen climbing higher. So what we're looking for is oil opportunities, euro dollar opportunities, dollar yen opportunities. They're the clear ones for today. So let's go and have a look. First of all, oil markets. Now, remember we looked at this before, a rising window. So what we have here, so if you take this out, is a rising window. Now this is where you get a runaway gap, right, at the open, and oil prices have just surged higher into this gap. So this is an area where you can start to expect potential dip buyers. Now, in this runaway rising window gap, there is another sort of area for you to look at, and it is the bottom part of the window here. So from a technical perspective, if you do happen to get a drop back down to that 93.32 level, it's possible to have a $1.50. I'm looking for that area to potentially hold, and you could try up to 3 times. So that's definitely an area we're looking at. Also, it's looking at potential breakouts of trend lines higher, just based on the current sentiment, which is negative for oil markets, which is pushing oil higher, because any further escalation, any further news that oil supply is not getting to market, Straits of Hormuz not being open, those sort of things, all will weigh on sentiment, and you can look for trend line breaks higher. But warning, choppy, because all of a sudden you might get an emergency release of oil reserves announced, and oil will drop sort of $3-4 dollars in an instant, and then maybe $10, $15, $20 over the course of the session, if not more. So be aware there's high risks with trading oil at the moment. But these are the ways that I'd look at it. So a dip down to the 92.67, the bottom of the rising window with a $1.50 stop. That's not unreasonable. So you're like literally looking for this, right? You can see that markets are trying to hold off the top of that rising window here. So you see, that's would have been a potential opportunity, but I find the bottom parts of those windows are the better parts. And again here, if we get a breakout above this level, right, then looking for potential breakout retest. So, aggressive entry would be on those breaking through those highs. or else looking at on balance volume pushing up and then looking to trail stops on the 15-minute chart, right? So that's for oil. That's how I'd look for oil. Now looking at the dollar. So first of all, just notice we're finding support in this region here. You can see that the yield spread is still pushing up between German bonds and US 10-year yields. So euro dollar buying, you can see the market was trying to buy this last week. And we've had one, two, three, four rejections from that level. The problem is that if this crisis carries on, then dollar strength makes sense. I prefer buying the dollar today, and there's two areas that are standing out to me. So first of all, again, you've got this falling window, right? Exactly the same principle, and I'm looking at the top part of this falling window in that gap from the Sunday open. So that would mean that if we go back up to that 600 region, right, I'm expecting sellers. And if we were able to go back above that 20 position, that 1622 region here, again, that's another area I'll be happy to short. So there's two areas I'm looking to short from today. Right? Again, just 4 or 5 point stop, that 1.1622 and or that 1.1600 level. Try up to 3 times with a stop of 5 points. That's what I'm looking for. Okay, very, very nice level and in line with more dollar strength. So that's euro dollar. Also worth looking at the dollar yen. So we'll just take a look at that. Now, the problem we've got here with dollar yen is we're heading up to that 160 region, which is the intervention level. We've got this big supply level up here, and the Bank of Japan, the US do not want to see the yen weakening above this 160 region. So there's a high chance of intervention here. Are they going to intervene with this crisis going on? Highly unlikely. So with the Japan being a net energy importer and the US producing more oil than any other country in the world, dollar yen upside remains reasonable. So we're looking here for somewhere technically savvy, and the obvious thing is another move on this rising window. And I think there's the potential to be a little bit more aggressive here on this rising window. We've started to see dip buying there. So wouldn't be unreasonable to just be looking for a potential long off the top of that rising window. Again, using 5 point stop, looking for dip buyers to come in there on the dollar yen. That's what I've been looking for. So it's dollar yen, euro dollar, oil. Now, the risk here is that there's a quick resolution to the crisis. If the resolution is quickly resolved, say the Straits of Hormuz open up immediately, expect oil prices to plummet, expect equity markets to surge, expect the euro dollar to surge. Right? So the flip side of this narrative is Straits of Hormuz open, US end their attacks of Iran, happy with the work done, anything like that, then you'd be looking for dollar weakness to come straight back in, oil weakness, and equity market buying. And I would like something like the DAX. I think that's one of the equities that's really been hit hardest. So DAX or Euro stocks upside, I'd see as having most relief, although you'd see relief in the ES, NASDAQ, and the Dow as well. So a straightforward day today. In terms of calendar, everything just being eclipsed by this energy crisis and the constant headlines we're having regarding the conflict. But aside from that, there's nothing really on the calendar in a major way. Just keep looking for dollar bids. That's the outlook. They're the trade setups that I've got for today. Now, the other option is say, we're not getting those moves, but we are seeing some dollar strength. Then you can start looking for momentum plays. Okay, so that would be looking for potential on, trend line breaks to the downside and the euro dollar. Looking at small flag patterns on the 15-minute chart, things like that. So if you start to see momentum just rushing ahead of us, then be looking at like flag patterns like we saw here, like that kind of flag pattern there, break, go with it on the 15-minute, like we saw with oil on Friday. Okay, we said on Friday, like the thing to be looking out for was buying dips in oil. So the sort of thing, as you see, the session just kept rising, and when you have a market like that that just keeps rising and rising and rising, looking for those trend line breakouts here. So you can see here there was like a mini flag pattern that was forming. I'm just going to try it. Right. Kind of flag pennant, rush up, break out, and on. Right, and that happened, again, even on the close. So that's the sort of thing to look for in the euro dollar, okay? And it's looking for downside, that kind of thing. Dollar strength keeps coming in, then looking at that kind of move. Pullback, break, confirm by on balance volume, stops the other side of the structure, going to 2 to 3 1 risk reward. Otherwise, pullbacks to that 600 or 622 level. And the final thing, be careful. Don't just enter, positions that are short or long with large stops. The chances of getting stopped out are extremely high on a day like this because the geopolitical headline can change just like that. And if you haven't carefully managed your risk and you've over leveraged, assuming dollar strength, assuming equity downside, you will get caught out. So make sure that you're always managing risk very carefully in a market like this. It's volatile. That does create increased opportunity, but it also creates increased risk. Okay, folks, take care. I'll see the rest of you guys for the future session later. Otherwise, look after yourself out there, be careful, and hope to see you tomorrow. Cheers to you. Cheers.